what is this, you may be asking? Well, it's going to be every Saturday. We're going to do interviews or just share my thoughts on 4 specific topics: macro, investing, entrepreneurship, and freedom and personal liberty. This week's guest is a good buddy of mine, the Uneducated Economist. He's a really smart YouTuber, and he's got some incredibly unique insights. You guys are going to love this interview, so let's dive right in.
2 years ago, I was sitting around trying to talk economics with friends and family, and they just their eyes with me, and I was like, oh gosh, I need to talk to somebody here. So I put out a video kind of introducing the Uneducated Economist. It was something I had kind of called myself a long time ago. Like, people would ask me, how do you learn so much about this? And I'm like, hey man, I'm the Uneducated Economist. I just read a bunch of stuff and I just kind of babble on around it. And I started that channel about 2 years ago. And then about a year ago or so, a little over a year ago, it really caught some attention and started taking off. And
that's awesome.
Yeah.
So I'm curious, what got you into macro?
Yeah. Wow. I don't know exactly. I had tried to buy a house in 2007. Right.
Okay.
So it was probably I don't know what month, April 2007. So 3 months later, the housing market crashed. Right. And, and so I was had no clue about anything at the time, absolutely nothing. And I was working construction, and there's this construction slowdown. I'm losing my job. I'm losing everything. I watch my savings go, and I'm like, what the hell is going on here? And so I would watch CNBC, and I would watch these guys talk, and it was just garbly going past me. I couldn't figure out what they were talking about, and it seemed to me like they were speaking in code. And so I would have my computer fired up, and anytime they would ever say something I didn't understand, I would type it into the computer and start learning about it. And so the first thing I typed in was mortgage-backed securities. I had no clue what mortgage-backed securities.
Dive in head first.
And then, And then the next thing I know is credit default swaps. And so I'm reading about mortgage-backed securities and credit default swaps, and I'm just like, whoa, what's going on here? And then my friend was like, well, it's all the Federal Reserve. And I'm like, what's the Federal Reserve?
The Federal what?
Right, exactly. The Federal who, And so he gives me the book, The Creature from Jekyll Island, right? And so he hands me this book, like this thick, and I'm like, are you kidding me, man? I can't read this, And he's like, dude, you gotta plow into this thing. You gotta do it. And so I started reading it, and it was very intriguing, but I have difficulty reading and comprehending. So I went to the YouTube and started punching in G. Edward Griffin and started watching a bunch of his speeches, stuff. And I got the gist of The Creature from Jekyll Island. And now I probably read that book, but not in one sitting. I've read every page of it, but just throughout time. And that really probably set me off on, after figuring out The Creature from Jekyll Island book and listening to G. Edward Griffin, that was probably what set the thing in motion. And from that point on, anytime I ever had questions, or anytime I heard somebody say something I didn't understand, I would go to YouTube or go to Google and just keep firing it in there until I figured it out.
Yeah, that's really cool. It's very similar to what I did. I've never taken an econ class or a finance class in my life. I almost flunked out of high school. I got through college, but barely, just barely. What were you doing in construction? Were you framing houses?
Yeah. Framing was pretty much my in. That's what I did. It was kind of interesting.
For many years.
Yeah. And, I really like the framing aspect, because it's really what gives people something to look at, all of a sudden once you put your job together, then now all the rest of the trades can start going to work. Now the plumbers and electricians and everybody else can start going. But until you do your job, there's nothing there. And, it's really exciting watching a homeowner or something come to the job site and seeing this big framed house, where before it was just an empty lot. And, that was it was very rewarding doing that job.
Yeah. I did that for a long time in Portland. I never got to the point where I was actually a framer. I was just always the laborer. So I was doing it during college and stuff like that. In fact, the guy that I used to work for back then, he and I now have partnered on quite a few real estate deals. So it's actually pretty cool. We're still really, really close. And that was, who knows how long ago. So what I wanted to do is start off by talking about one of your recent videos that I saw, where you were talking about the Polish borrowers, the people that took out mortgages in Swiss francs so they could get a cheap interest rate. Then all of a sudden, when the Swiss franc appreciates, I'm not sure how much it appreciated by, but then, they're paying their loan back in currency that's a lot more expensive. So they're high and dry. Tell me about what actually happened there. I think that's really interesting.
Yeah, it is a really interesting story. Now, it was just one case that they're talking about. It's just one borrower that was able to get their case to the Supreme Court, but it sets precedent. I mean, this is now it's
Right.
like it's case. They got a case to work off of, and this is what really set the panic go through the banking system over there in Poland, where all of a sudden, this borrower who had signed a mortgage saying that they would pay back their mortgage in Swiss francs, and the bank was offering them this mortgage to pay back so that they could get this really good interest rate. So they're paying back their mortgage. Everything's cool. Well, this was years ago that they did this. Well, as time goes on, they realized, oh man, I'm paying back in an expensive franc because the franc has gotten so much stronger. So now they have to come up with ever more of their own local currency in order to pay back this mortgage. And they went to the court system saying, hey, this is unfair. We can't do this. And, unlike most, like probably in America, they'd be like, well, tough luck. You signed the contract. Over in Poland, they said, you're right. You don't have to pay back that thing in francs. You can pay it back in your local currency. And they rewarded it with the lower interest rate on top of it, too.
Lower, that was crazy.
Super crazy. So, now here you got these banks out there who are just like, crazy wondering what's going to happen with the rest of these. Are they going to be able to take this all to the court system? Are they going to be able to, all of a sudden just go into the local currency with the low interest rate, which pretty much, kind of screws the bank, because now they're, instead of getting the good franc, strong currency in, they're getting the weak, Polish currency in, and not as much money off of it. So.
Yeah, and I don't often side with the bank, but in that case, I think you've got to. And maybe I don't know some details, but also it not only hurts the bank, but in the long run, it'll hurt the consumer, because the banks will have to charge a higher interest rate for those mortgages to compensate for any future risk that they may have by that setting a precedence and having a borrower, come back at them.
Right. And I mean, you think about this. I mean, if it can happen to the investor, the lender, to the borrower, I mean, if all of a sudden the guy who's on the other end, who's lent out the money or investing in the mortgage-backed security, so to speak, or whatever they got out there, how is that not going to flood into the rest of these guys thinking I'm not going to loan any money. I'm not going to buy these things. And what's going to cause the interest rates if nobody's out there trying to, support the real estate market with the mortgage-backed security purchases and stuff. So, I mean, it can really, that decision really can create a much bigger ripple of problems throughout the rest of the system. I think they realize it's not just rewarding some borrower to say, hey, you got tough luck here, let's help you out. I mean, this can really damage the psychology of the banking system out there, the people who actually have the money that they're lending into it.
Yeah, I think that's a great point. Maybe you could expand a little bit on that, because I think a lot of my viewers and maybe some of your viewers have this idea, kind of this old school idea of banking, where a bank would take a depositor's money, they would lend it out to XYZ borrower to start a business, buy a car, buy a house, and then they would keep that loan on their books. And the person who was paying that loan back would pay the bank directly. And that's kind of the relationship that's kind of how it was maybe 30, 40 years ago. But now, that before that ink is dry, the banks have sold that paper. They've sold that paper into the market, and now it's like the banks are just kind of like a middleman, just to move as many loans as they possibly can and collect the fees. Maybe you could explain that to the viewers who might not be privy to how that works.
Yeah, because that is kind of a common thing that that people have this idea that they put their money into the bank and then the bank lends their money out and that's how they make money. But that's really not the case, because a bank could really function without any depositors' money at all.
Right.
Pretty much what ends up happening is that when you sign that loan, they're selling that loan off to somebody else. And in the idea that really a bank can function without a depositor means that the bank wouldn't make as much profit. So this is basically how it goes down. When a bank makes a loan out there, they have a balance sheet where you have assets and liabilities. The asset is the loan, the piece of paper that you signed, and the liability is all the money that they lent out there. So now they can send that off or, sell it or do whatever. But if they were to hold it, so to speak, they can then offset their balance sheet by taking in depositors' money. So the liabilities that they've lent out, if they can get some of those liabilities back on their balance sheet, now the liabilities have increased and the balance of their depositors have gone down. It's hard to fathom that this entire debt-based system is literally that. It's all based off of debt, and that every time somebody puts a deposit into the bank, that's offsetting somebody else's debt. It's just like, to think that a bank can literally say, hey, you want to buy a car? No problem. Give me just a second. I'm going to go borrow the money and lend it to you. And then I'm going to take the profit in between. Because
they're
that's
just going to create the money. They're just going to create the money. They're just going to type it in their computer and bam, it's in your account.
And then there it is, right into the account. And then the idea that the money has backing is because you have promised to pay it back. And that's, and whether you do or don't, doesn't matter at that point, because the money is now in the system, the guarantee is, the guarantee, that you're going to pay is out there. And that instrument of debt is the only thing that the bank really wants because they're selling that piece of paper that you have signed.
Exactly. So, okay. So let's go back to that. So now that we kind of understand a little bit better how let's call it fractional reserve banking on steroids works, we go back to what you're saying, where they're just taking that loan and they might not be, they most likely aren't going to be keeping it on their books. They're just going to sell it into the market. And then Wall Street, for lack of a better term, is going to just bundle all of those loans into, mortgage-backed securities or the asset-backed securities.
That's
what I was thinking, right?
Yeah.
So that's where they're kind of bundling, subprime car loans and mortgage back, just kind of everything into this stuff.
Everything, credit cards, all kinds of stuff into there, right?
Right. And so then it's either going through Fannie and Freddie if it's a home loan, they're bundling it and throwing it out into the ether, or the banks are taking it and then bundling it themselves. In the case of Santander, they're the biggest subprime car lender in the world, I think, or right up there. So they're lending out all that garbage debt, these auto loans, and then they're bundling it and selling it to investors who want a little bit higher interest rate. And because the Fed has kept interest rates so low for so long, and everyone is starving for yield, especially these pension funds, that they're willing to go out the risk curve almost indefinitely just so they can meet that 7% requirement that they have. But if you think it through, okay, bank creates money from nothing. They take that loan that is really just that they just created, then they sell that. Wall Street bundles that with a bunch of other loans that aren't created with anything other than digits that were just typed into a computer. And then they sell it to other investors who might package that into some other derivative. And then it goes off into all the, and from there, I don't even know where it goes. But it's just such a daisy chain of it's such a domino effect that because of this daisy chain, that if just one thing tips over, it just seems to me like it could crash the whole system. I don't know if you saw The Big Short, but remember that scene where they did the Jenga thing to explain how these mortgage-backed securities, or these tranches work, and they just took out that very last Jenga piece, and boom, the whole thing comes crashing down. And it seems to me that's the entire monetary system. Am I way off base, or what do you think?
No, it really does seem to be. That's the entire, and then not only is everything that you have taken out as far as a loan bundled up into these packages, but then there's also the insurance policies that have been sold to go along with these packages, which is where that Big Short really starts coming in,
Yeah.
Because I don't know if you went and saw the Sears
swaps, right?
Right, the credit default swaps. But the Sears story that took place a year and a half ago or so, where they started to go into the default, where they had these special notes where they had their corporate debt that they had sold off, but there was these special notes that they owned in-house, and they had to sell these things off. And there was a credit default swap that was attached to these things. And the guys who were going to end up paying out on that credit default swap went to him and says, hey, what is it going to take to keep you guys going for a little bit longer in order to not have to pay this credit default swap?
You gotta be kidding me.
No. So like I was thinking about this. I'm like, holy moly, that's a great credit default swap there. Wouldn't it be nice to get paid, not to have to kick that thing in there? So they're literally the idea of paying a company to exist, to continue to just be a company in order to carry that credit default swap on longer. Because as long
the zombie company.
The zombie company, because it's not like you buy the credit default swap one time, it's a monthly payment, right? I mean, it's like an insurance policy. You got to keep paying on this thing. And so what is that saying about, the market can stay crazy
irrational
longer than irrational, right? So yeah, so that's what's basically going to happen, is that these credit default swaps is like, they can just keep the people who issued them can keep the companies alive and keeping you having to pay on your credit default swap, It's a very crazy system, isn't it?
Yeah.
So now I think about like, how big is this shadow market and how much of these things have been like piled on top of each other, because like you think about it, this company fails, the credit default swap kicks in or doesn't kick in. Now it's not so much about the company and whether or not it's functional, but it has to do with this credit default swap and whether or not somebody's going to keep paying the company to exist.
Exactly. Let me write, when you're saying that, let me write something down here, because I don't want to
one of
forget
the other things that also went along with it is that, these companies, they're like, hey man, you're a zombie company and I got this credit default swap on you. How much would it cost to go ahead and just let you guys default? Like if I paid you to default, kicking that credit default swap in and getting me paid.
Right.
That's the other side of it. So now you got these people who are on the other end, like fighting over a company that shouldn't exist in the first place.
Yeah. And I think the great point that you brought up is when people are investing in the financial economy, let's just call it that. And whenever you're getting a piece of paper in exchange for your hard work, whether that's a bond, whether that's an equity, whether that's a piece of a company, that's part of this financial, what I call a financial economy, that is far, far too large for the actual real economy of producing goods and services. But what most people don't realize is everything other than gold or precious metals has counterparty risk.
All right.
So you may think that, wow, I've got $1 million portfolio because I own this stock and I own this and I have this money market fund and I have, down the list. But you don't understand that if everything comes crashing down, you have nothing, because all you have is a portfolio of counterparty risk. That's it.
I call it an envelope.
I don't think people realize that.
Yeah, I call it an envelope that shows up in the mail. That's what you got. You don't have anything real. Like, what if that envelope doesn't show up? Who are you going to go to? Whose door are you going to knock on to try and get your money? I mean, what if they don't answer the phone? They don't answer the emails. It's gone.
Yeah.
What do you have? You can have cash. Cash is a good thing to have, but even cash deteriorates over time. It deteriorates in the purchasing power of it. So there's really nothing out there that you can do except for gold and silver. It's the only thing out there that is, and I mean on a lesser extent cryptocurrencies, but throughout history, there's nothing else that compares. It's it.
Right.
That's it.
Right. And I would say that there's counterparty risk in that cash, because your counterparty is the government, and trusting that they won't inflate it to oblivion.
Yeah, because what is cash? I mean, it's the liability of the Federal Reserve, and what are they using to back it? Yeah, they're using IOUs and they're using mortgage-backed securities. So that's essentially just another promise, I mean, so it's an empty promise essentially stacked on empty promises. Yeah.
What do you think about, like, if you go to the New York Fed's website, you can see what the Fed's balance sheet consists of. It consists of this, as far as their assets, this many treasuries and this many mortgage-backed securities. Most people don't realize that the Fed at one time had a good percentage of all mortgage-backed securities in circulation on their balance sheet.
Yeah.
When I mean a good percentage, if my memory serves me right, there was about 15 trillion of outstanding mortgages, and the Fed had about $1 trillion on their balance sheet. So what I was wondering, and I'd love your opinion on this, is the Fed propping up the housing market by buying potentially non-performing mortgage-backed securities from these banks, so the banks don't have to foreclose on the borrowers. They keep them in their house, which creates less supply, which of course buoys housing prices. What do you think about that?
Yeah. Well, absolutely. I think the Fed is supporting the housing market for sure. Had they not gone out and purchased all those mortgage-backed securities, the mortgage-backed security sellers would have had to rely on the investors of the world to try and buy those things. And if people weren't into buying them, then the interest rates on them start going up in order to find the investor to pay for them. If the
interest rates go up,
that's right.
Yeah.
Yeah, if the interest rates go up, then that means you're going to end up paying a lot more on the monthly payment on your house. And that means less house of you that you're going to be able to buy. Prices start coming down. So,
I want to interject one thing. If the interest rates go up, that means the value of those mortgage-backed securities goes down. So if they need liquidity and they have to sell that mortgage-backed security, they're going to get pennies on the dollar if they don't have a backstop that is the Fed that can just print money and bail them out. Basically, we think that this bailout occurred just in 2009. It was all about TARP and Paulson and all these guys. But if you look at the Fed's balance sheet, I mean, you can't prove it, of course, because we can't audit the Fed. But you sit there and scratch your head and look at what their balance sheet consists of. Look at the housing market. Look at these more, and it's tough not to come to the conclusion that they're still bailing out the banks and whomever was holding the bag on those garbage loans. They're still doing that to this day. It's just, I don't know, maybe they're not, but that's what it looks like to me.
No, that's what's happening. I mean, that is what's happening, because like I said, if they were trying to rely on just the world investors to buy those mortgage-backed securities, they wouldn't be going for what they are. The interest rates would be a lot higher and the price of them would be a lot less. And, you know, the problem with like swelling it up, anything like bonds or anything that has like these mortgage-backed securities, people love them on the way in. They love it when the prices are going up.
Right,
like you can find all kinds of people willing to buy them, but the moment that it switches, it is gone. There is no more buyers left, and the liquidity leaves. And it's like what, a highway going in and a goat trail going out. Isn't that the way they refer to it?
Or the movie theater analogy. Yeah, exactly.
In movie theaters, somebody scream fire. Not everybody's going to get out the exit door. You can't do it. There's just not enough, you know, pretty much there's just not enough people out there with the money to willing to buy it. And that's the easiest way to explain it. And so once those prices start going down and the interest rates start going up until they can find an investor, that's what they're going to do. And yeah, they would wreak havoc throughout the market. You know,
and then the credit market freezes up. And that's the one thing I get all the time is people say, oh, you know, we're not going to have a big housing crash again because it's different this time. And the lending standards are a lot better than they used to be. And I always remind people that, well, first and foremost, in a lot of markets where the price is higher now than it was in 2006, even adjusted for inflation. But in my opinion, the housing market can crash without that being the catalyst. So in 2008, 2009, the catalyst to the recession was the crash of the housing market. But in my opinion, the next recession, whatever that catalyst may be, the catalyst might not be the housing market, but the next housing crash, the catalyst most likely will be the recession. So it in my opinion, it'll just be in reverse order. So maybe said a little bit better, before the housing market created the recession, and this time I think the recession is going to crash the housing market. Yeah,
and you know, really, I think it's going to end up being, because I think Peter Schiff probably says it the most, that it's going to be a sovereign debt crisis.
Yeah,
but it's probably going to start off in the corporate debt market, is what I'm assuming. Is that at some point the corporations are not going to be able to borrow money like they were, and when those debts need to come paid and they don't have the cash, they're going to start selling their stock. And so you're going to see the stock market and the bond market start going down at the same time as the corporations are selling their stock in order to try and make the bond payments that they,
which makes their credit rating go even lower, which makes it even harder for them to borrow. It's just you get this feedback loop.
And then, what happens when the credit rating goes down? Pension funds need to start selling. And so now you have like a forced sell, and like pension funds got to get out of it regardless. It's not like they can wait and hold on till, you know, the market returns. They have to bail out. They have to get out. And Yeah, I mean, once that starts rolling, the bond market, I don't think would be like, especially the corporate bond market as a whole, could like stay out of the sovereign debt market. I mean, bond investors are bond investors, unless the Federal Reserve steps in and starts buying corporate debt. I mean, I guess they could do that.
Yeah, I think they will. I mean, I think they will. I think they'll bail out everyone. I think the next kind of phase here, I was going to ask you what you're really looking at in 2020, but for me, it starts with MMT. And I've said this on a few podcasts, but I think it's worth reiterating.
Mm-hmm.
I don't like it, but I think it's inevitable. It's
I do
inevitable
too.
because you look at the left, obviously they're all about it, but the right's all about it because it gives a politician an open checkbook. And what politician, it started with Keynesian economics. Keynes came up with this idea, presented it to the politicians, and they look at it and like, that is the most amazing thing I have ever seen. We've got this respected economist that's basically telling us the more money we spend, the better it is. And I know. And people are going to come after me and say, George, that's not what Keynes said. And I get it. But his theories have devolved. I was going to say evolved, but let's say devolved so heavily that it's not even anything what Keynes prescribed. It's kind of close, but if Keynes was alive today and saw what people are calling Keynesian economics, he would freak out. I mean, he'd have a heart attack. So, and Milton Friedman always used to say that as well. But my point is that these politicians just take bits and pieces of whatever they want and use that as justification for buying votes. And that's Keynesian economics. MMT takes that to a whole new level. And so what politician is not going to want to jump on that boat? They're all going to jump on the boat, in my opinion. And then what I think is going to happen, and I'd love to get your thoughts on this, whenever I've studied the markets or investing, it seems to me that the market, obviously the market isn't a living, breathing entity, but if it were, it seems to me the market tries to hurt as many people as possible. So it waits till everyone gets on that side of the boat. Look at the .com crash. Everyone, your grandma's buying .com stocks, your Uber driver, every single person's doing it. And as soon as that last person gets in, boom, the boat tips over and you're done. Same thing with housing. I think the new thing that people are, and let me back up here. And I think it always involves something that people never expect. So .com, they think that these stocks are going to the moon. It's a whole new paradigm shift. The economy is going to change forever, so let's buy pets.com. In 2006 or 2005, nobody thinks the housing market can go down. And of course, there are guys like Schiff and a couple others. But for the most part, nobody. That was just heresy. You were just put on the tinfoil hat if you thought that prices could ever go down. But now I think that if you look at society, not just the CNBC talking heads, but if you look at the average Joe out on the street, the new housing market can't go down idea is inflation, in my opinion. We'll never have inflation again. We've hit a paradigm shift. We never have to worry about the 1970s. That was old. The monetary system is new now. We've gotten over that. We're never going to have to worry about that. Just forget about inflation. And in my opinion, that's everyone going to one side of the boat again, that we're never going to have inflation again. So let's just print and print and print and print, because now, since we have the power of the purse, as the MMT people would say, we don't have to worry about these chains of selling debt that have restricted our growth in the past. So if you want to bail out the pensions, boom, done. If you want to bail out student debt, boom, done. If you want the Green New Deal, boom, done. And then the market is going to wait for all of them to get on that one side of the boat. And then it's going to wait till they've printed. Let's say the Fed's balance sheet is now 20 trillion and they're just whistling by the graveyard. they're taking a victory lap saying, I told you, George Gammon, I told you, uneducated economists, there's still no inflation. And we've printed $20 trillion. And all of a sudden, the inflation genie gets out of that bottle and boom, it just takes everyone, right off a cliff. That's how I see it kind of playing out. What do you think?
Well, I think that's probably a very realistic way. I mean, what was it? Mike Maloney's stuff. What does he do? The Hidden Secrets of Money.
Yeah, I love it.
In one of those, he was talking about the Weimar Republic and how everybody was getting real nervous about the banking system, and they started pulling cash out of the banking system and stuffing it under the mattress, right? And when this happened, the banks were like, "Oh crap, we need to start printing up money," and they started printing up money and to keep the banking systems going. Well, everybody's sitting at home looking at the banking system, going, nothing really happened. Everything's cool. So they started pulling that money back out from underneath the mattress, and that money velocity really started clicking in, and that was what really triggered it after that. So very similar, very something like that. There's no inflation. Keep printing, and all of a sudden, bang, there's inflation, and now you can't stop it.
Another thing I want to point out, have you seen the chart lately of M2 money supply and the velocity? So if you look at a chart, M2 is just hockey stick, and then velocity is off a cliff. So you have all this money out there, but you have velocity at drastically at an all-time low, not just slightly. So, how does that work if we have velocity go back up or even exceed that when you've got exponentially more M2 out there or more money supply? I mean, that just goes right back to what you're saying. It's a recipe for disaster.
It really is.
But I think that's kind of the end game. We'll see, if I'm right or wrong there. So one thing I want to run by you here, I was doing some research this weekend with this professor. I can't remember his name. This guy's a really bright guy, and he talks about how the banking system has really changed, and from fractional reserve banking to, I don't know if he's got a name for it. I just call it the fractional reserve on steroids. And he, as an example, and I don't know how much evidence he has for this, because he's just said it a few times in interviews. So, who knows where he's getting the data. But he said, he used as an example, back in 2008, and this was in Europe, in Britain, there were, I don't know if it was Barclays, I'd have to look at the names of the banks, but all of their banks needed a bailout except for two. So his point is, why did these two banks not need a bailout and all of the other banks did need a bailout? And his hypothesis, he says that it's fact, but I'll go ahead and call it a hypothesis right now, is that, let's just call it Barclays. What they did, because they can literally create their own money, but they can't do it unless they have a borrower, or it's just straight fraud. So what they did is they called up their buddies at the Sovereign Wealth Fund in, it was somewhere in the UAE. I don't know if it was Dubai or one of those countries, and said, listen, guys, we're in trouble. We need a huge favor. We need you to lend us, it was, let's just say $7 billion or $10 billion. And they said, no, we can't do it. We don't, you're going under, forget that. And I said, okay, well, let's do this. Why don't we lend you the money? We'll create it. We'll lend it to you. We'll just keep it in our account. And then you lend it right back to us. And that's what we'll use to stay afloat. And then we'll pay you a huge premium, under the table. And they said, sure, let's do it. So they literally created their own money to stay afloat to keep from going bust in the last financial crisis. There were two banks that did that. So where do we go with that? I mean, is it to the point where banks can just bail themselves out and we don't even need the Federal Reserve?
Wow. I got to roll that one around for a little bit to think about that. That is like, I mean, because, to think that, it's just like, well, I don't have anybody to borrow my money. Well, here, I'll just create, some money, and then here, why don't you let me borrow that money that I just created?
Yeah.
that's hard to even like, wrap your head around, like, how is that supposed to, how, because you think about it, it's like the whole idea that money has value is that there's some kind of limitation to it, that
Right.
there's
Scarce
like,
resource.
in that, but man, yeah, I'm gonna have to do a little bit of thinking on that one to really kind of like, mull that one over, because it just doesn't even seem like that's possible, It's just like
I know. I know, but that's just kind of I mean, we were talking about how crazy the banking system is, and I think that's just the icing on the cake. Just when you thought it couldn't get any crazier, it's like boom, there you go, and you're like, wow. How does this end well? That's my question.
And that's what really gets me about it, is because, like, when I first started looking at this stuff, I'm like, oh man, the dollar's going to totally crash here within 10 years or whatever. And then 10 years goes by and I'm like, wow, I'm really bad at this, or am I just early, or am I just realizing that they just changed the rules and I'm like trying to play, or at least kind of understand the game by certain rules, and then when the time comes, they just change it around. They just make it different. Things that didn't exist before now change. You think about like that repo market. That was something that was just like, it was something that was like kind of a safety, for the Fed. It was just like, it was something that is kind of like, occasionally used when things kind of got a little issue. Now it's like, here's our tool. This is what we use all the time now.
Well, 300 billion a night. 300
up
to 300 billion a night.
Yeah, and that's just like, at first, when it first happened, I'm like, man, this is really big news. But then, it just kind of fades away, and now it's just commonplace, and now it's the new tool.
Yeah.
That they use.
Yeah, the temporary glitch that goes to a permanent 300 billion a night, it's just out of the news cycle. So it's no, I guess that's no big deal. Like, let's just forget about it.
Right, and that's what I'm still like, still stuck on that. I'm like, this is supposed to be a big deal. This is, there's supposed to be things and changing, and and it's although it is a big deal, it's just like, it's just gone, and that's what I think, like the like the short-term attention span, like the short attention span that people have on things.
Right.
They hear it, they get excited, and then it's gone. I think about like the wall, when it was a big deal. I mean, I had buddies who said they were going to grab guns and go down to the wall and protect the border, and I'm like, are you guys really that nervous? I mean, are you guys that scared? Is it that big of a national security? And that was the only thing people talked about for the longest time, shutting down government because of the stupid wall. Gone. Nobody talks about it anymore.
When I was in Tucson helping out my younger brother, and that's when I had a bunch of those trucks, which actually I still have a bunch of them, and I was buying them on Craigslist, and I'd take them across the border down into Nogales, because Tucson's just an hour away from Nogales. And I had a body shop down there that would do all the body work for me, and I was getting it so cheap because we're at 19 pesos to the dollar, and then I'd come back and I'd flip it on eBay, and I was doing that just to do something because I had nothing else better to do, because I was just there helping my brother out for a year. But the funny thing is I had this one guy, and he's just an awesome body guy, and his name's Danny, and he's still down there. I'm still thinking about doing more business with him, but we got to talking one day, and I mean, he's Mexican and just right there on the border town, and you go across the border and you got the big fences and all these things that Trump always tweets about. And I asked him, I said, Danny, could we get you a work visa, because you are so damn good? I would be willing to invest, let's say 100 grand or whatever, on starting a body shop in Tucson, as long as you operate it, and we'll just do like a 50-50 split or something. And he's like, yeah, I might be able to do it, but I can't do it for probably 3 years. And I'm like, okay, well, why is that? And he said, well, I kind of got caught in the United States. I was working in Chicago, and I went there illegally. I'm like, okay. I'm like, how did you get there? Like, how does that work? And he almost starts laughing. This is a true story. Almost starts laughing. And I'm like, well, what's so funny? It's like, well, you just walk across. I'm like, what do you mean you just walk across? And he's like, yeah, you see the big fence there, but the fence only goes like a mile. He goes, we just walk down the road and just cross over and just walk up to the bus station and take a bus to Chicago. Like, it's just it's easier than you just walking across the street to pick up the mail or whatever. And I was just like, they make all this fuss about the wall and the border and all this stuff, and the security. Shit, when I'm sitting there at the security gate trying to get back, they're sweating me. It takes me an hour to get across the border, and Danny can just walk a mile, and he gets across the border faster than I do.
Oh yeah.
It's just
like,
crazy.
I mean, I'm in the construction trade, for the most part. I mean, I don't do construction. I sell building supplies, but I talk a lot with the workers there, and I asked them. I was just like, "Hey, listen, how many illegals is it going to stop this wall?" I asked the guys, the framers, the Mexican guys, and straight up they said no, none. They said that ain't going to work. It ain't going to do anything to stop them.
They got tunnels. It's stupid.
Yeah. And right. It's a silly concept.
All right, so one thing I want to leave you with, noodle over this, and next time we talk, let's talk about this. So you talked about the dollar not going down. I want to circle back to my opinion, and I've heard this from some really smart people, just not me or anything. I'm just kind of regurgitating what I've heard. One of the reasons for this is because you have all this external demand right now for dollars. And what I think is interesting is it goes back to your point about the Polish borrowers.
Yeah.
So it's the exact same thing. So the Polish borrowers were borrowing in francs because they could get a much lower interest rate. Back in 2014, when the dollar was down, all of these countries, sovereign, corporates, everything, they said, wow, why should I borrow Colombian pesos when I'm having to pay a 10 or 12% interest rate when I can borrow in dollars and I can just get a 2% interest rate? Well, that's fine when the dollar is at 75 on the DXY. Now, it's at 98, maybe 97, 98 right now. So my point is that the exact same thing that happened to the Polish borrowers is now happening to the entire world outside of the United States, because they loaded up on all this dollar-denominated debt that they now can't pay back, or are going to have a really hard time paying back because the dollar has appreciated so much relative to their local currency. It's the exact same thing you're talking about with the Polish borrowers.
Yeah, this is the currency wars. I mean, this is
right.
where, and as much as Trump screams for a weak currency, if you notice, occasionally he'll slip up and he'll say, yeah, we're beating them because of our stronger dollar. That's
got a lot more control.
Yeah, and that's more of the statement that I like to hear, because that's the truth of the matter, is that every time our dollar gets stronger, he's nailing these other countries out there during the currency war. Now, I can only assume the reasoning for this is to keep that dollar, keep people buying into it. See, I guess really ultimately is that we want people to keep buying our debt, right?
I was just going to say, it's treasury. It's all about treasury.
It's all about the treasuries. Yeah. And if we can, and although Trump's screaming like, I want cheaper interest rates and I want all this other stuff, ultimately the stronger dollar is killing these other countries. So if you're fighting a war and it's about who has the strongest dollar during that time, now I know they keep saying it's a race to the bottom and that's how you win the war, but really you think about the damage that a strong dollar is doing to these other countries, who's really winning the battles here?
Yeah. And China's out of dollars too. China's really in a bind right now because their dollar reserves have been depleted so much. But
so I just try to think of what is it like if I was in a foreign country and I was sitting there looking at what's going on, my country's going into negative rates. I look at all the kind of turmoil going out there, and the United States has the best paying interest rates, the most stable, the king dollar. Why wouldn't you go there? Right? It just seems that the world at one point, even though it's not a safe haven, it's just as dangerous as anything else is, but the world perceives the dollar as a safe haven asset. And until they change that perception, or something happens to change that perception, they're going to dive into it at some point. And I think that the dollar is going to get incredibly valuable at some point. I think that
you're on the Brent Johnson side.
I am totally on the Brent Johnson side. Totally.
Okay.
And I see that happening. But it's not just him, because Jim Rogers says it too. He said that the same thing. He says that at some point, people are going to, they shouldn't, but they're going to think of the dollar being the safe haven place to run to. And then after that, it's going to be gold. Because I think gold and the dollar are going to run together, honestly. I think those are going to be two assets that are going to run right alongside of each other.
Yeah, because instead of it being all about inflation, now it's all about a safe haven.
Safe haven, that's it. They're not going to worry about, people are going to be less concerned about making a profit off of their money or making a return on their money as they are as just preserving wealth, because as everything starts to deflate and they don't know where to go, that's the only thing that's going to be on their mind is don't lose money, don't lose profit, don't lose power, purchasing power.
Yeah, I think it was Rick Rule I heard the other day. It's just such a great line. He said that gold is the inverse of your confidence in the system.
Yeah, that's exactly it too. It's, and that's because I have a little bit of investments, very small amounts, but the majority of anything that I've ever bought has been precious metals. It's where I feel comfortable, it's like when I buy it, I don't stress it. I don't worry about what happens with interest rates or wars or currencies or anything else, because it's there. It just sits there, and may be collecting dust, but it's something I have, I have a lot of confidence in. I have a network built with it. So if I ever need money, I can liquidate it easily.
Yeah, right.
I like it.
For more information like this, check out this content right here, and I will see you on the next video.